Joining me now is Chris Wheaton. He's an oil and gas analyst at Stifel. Chris, welcome. It's good to have you. $200 a barrel. How do we get to that figure?
Well, Kelly, it's pretty simple. If you want to cut all of Russia out of the global oil market, and remember, Russia is the world's second largest oil exporter, just behind Saudi Arabia, at about 7.5 million barrels a day, you need to pull all the levers of supply to put on as much oil into the market as possible. But you also need to kill demand, because that supply isn't going to be enough to push all of that 7.5 million barrels a day out of the market. And if you look at where demand destruction kicks in, if you look back in 2008, when oil prices were last, at a peak of $140, $150 a barrel, adjust that for inflation, and that's how you get to $200 a barrel today. And that's not a price that really we think the global economy can afford.
Quick note on this, because there's been a lot of discussion about that this week. How much demand destruction did we see during 2008? And could you disentangle it from the fact that the U.S. economy was already in recession and about to hit the depth of the financial crisis?
Well, it's difficult to disentangle one factor from another in terms of the economic crash. The real impact came in the second half of 2008, where we saw the global financial crisis really kick in, and particularly, obviously, in that period of the September and then leading into the fourth quarter. You are talking about having to take, we think, not just demand growth out this year, i.e. bring that down to zero, but probably take another 2 million barrels a day off the market on top of that, if you want to take all of Russian oil off the market. That takes oil demand back to 2017, 2018 levels. That's a measure of just how much you've got to kill demand if you want to keep Russian oil off the oil market globally.
Shepard Smith here. Thanks for watching CNBC on YouTube.